Okay, today we're going to take this a step further and talk about how to incorporate inflation and also risk into the capital budget. We spent the lecture talking about inflation. Since this is an introductory class, we're learning the vocabulary, and the vocabulary that we focused on was real and nominal cash flows and real and nominal prices, and we finished talking about real and nominal interest rates. The next step is to see how to use these definitions and this information in the capital budgeting process, and that's what we will do today. We'll look at how to incorporate inflation into the capital budget, and then we'll also look at how to incorporate risk into the capital budget. We will talk philosophically about certainty equivalence and about probability analysis, but then we will focus and use in this class the risk-adjusted discount rate. And we'll use that latter because it's more intuitive, it's easier to use, it's a succinct way to incorporate that into the problem. You're in chapter 11. Again, I encourage you to read it. So our focus today on this lecture is how do we incorporate this inflation into the capital budget. And hopefully you recognize that that's something that we can't ignore. Because if an investment has positive cash flows, but it's just keeping up with inflation, then we have no increase in our wealth. And obviously, if we're going to have a capital budget, our goal is to increase our wealth through time. So it's something that we have to factor in, and the higher the inflation, the more money we have to make on that investment just to break even. Here are the rules that incorporate the definitions that we went over on Monday. To incorporate inflation into the capital budget, we are going to discount nominal cash flows with a nominal discount rate. And that's why it's important that you understand the difference between real and nominal, because you have to determine if a cash flow is nominal, you have to know what is the nominal discount rate. Also, we can discount real cash flows with a real discount rate. Either approach, it will give you the same net present value if you do it correctly. However, with nominal cash flows, we can more accurately account for taxes and financial feasibility that we will talk about on Monday. So in this class, we're going to keep things straightforward, and we're going to determine what are the nominal cash flows on an investment, and we will discount it with the nominal rate. Although there are some efficiencies sometimes in discounting real cash flows with real discount rates, but that's a complexity that we don't need in this class other than for you to recognize we could do it that way. Okay, so the example that we're going to use, again, is the center pivot irrigation system. We're riding this horse through the capital budgeting process, just adding new bells and whistles as we go along. In this case, we're adding the inflation and risk. So, problems for classroom discussion. If on page 44 of your handout is where we talk about this particular center pivot irrigation system. And it's useful that you look at that because as you're already finding out and discovering that one of your big problems in solving your homework problems is understanding the verbiage. What is wanted in the problem? How is it worded? How do you pull the information out? And so it's good to read through this and see how I word the problem is how we pull out the numbers. Although I will say that if you think extracting information out of these homework problems are hard, the real world is a lot harder. It's harder to get all of this information into the correct framework. Okay, if you look at this problem, we know that this farmer again can purchase this center pivot irrigation system for $80,000. The next component, you remember we got the 4 components of the capital budgeting problem, so it shouldn't be a surprise now that we're going to talk about the nominal after-tax net returns. But in this case, notice that we've added a new term. Before we just said the second component was the present value of the after-tax net returns. Now we've added the nominal, because in an inflationary environment, we said that we have to discount the nominal cash flows with the nominal discount rate. So we have to figure out how to calculate what is the nominal net returns. And remember, nominal, if we're looking at the cash flows, or the countable dollars. How many actual dollars, physical dollars, are going to come into the company each year in this inflationary environment? In the text of this problem, it said that the farmer expects the irrigation system will increase real operating receipts by $18,000 per year, but will also increase the real operating expenses by $4,000. In this particular case, the farmer expects his real net returns will be $14,000. That's meaning if he's saying that if he didn't live in this inflationary environment, he'd expect $14,000 increase each year if he purchased the irrigation system by controlling the water, by increasing the yields. This is what he expects. But this farmer's living in this inflationary environment, and he's expecting that inflation is going to be at 4% a year. So assuming there's no relative price changes that goes on in agriculture, although we will talk in another lecture the fact that there are relative price changes, but right now let's keep it simple, focusing on inflation. We're assuming that there's no changes in relative price levels. We just expect that the prices of corn or wheat or cotton are all going to increase at the rate of inflation. So we have to calculate the nominal after-tax net returns per year. We know that the real increase is $14,000. Well, what is the nominal? And we have to pay taxes on the nominal. So, probably hate to see this, but we're going to do another table. We're going to systematically solve this. And as we look at this table, I'll work through it column by column. We look at in this first period, we said that the real net returns were going to be $14,000. We also said that the farmer expects inflation to be 4%. Now, we said that we could convert a real cash flow to a nominal cash flow by compounding at the rate of inflation for n periods. The real net returns is $14,000. The inflation is expected to be 4%. So what does this farmer expect the nominal net returns to be in that first year? And in this case, the farmer then expects it'll be $14,560. He can still only buy 14,000 apples with that, but the actual countable dollars that come in that end of the first year is $14,560. Now we really want to know the after-tax nominal value, and we know then that Uncle Sam, because this farmer's in the 20% tax bracket, again that you can read in the fine print of the problem. The tax rate is 20%. Uncle Sam wants 20% of that. Even though some of that is not a real gain, nonetheless, your government wants the full 20% of that taxed. So we do 80%, 1 minus the tax rate. The farmer gets to keep 80% of that nominal return, which happens to be $11,648. Notice in the second year, we go through the same process. The real net return, because we're assuming no relative price changes, we're assuming that everything is constant in that sense. If we're going to find its nominal value, we're going to compound that at the rate of inflation at 4% for 2 periods. That means that this farmer actually, his net returns coming from his farm because of that control of water, the extra income coming in that end of that second year is $15,142. Well, Uncle Sam wants his portion, so he only gets to keep 80% of it. So he keeps $12,114 of that net return after tax in the business. On the third period, notice again that the real net returns is $14,000, again because the relative price changing, we're keeping that constant. But in this case, we're compounding at a 4% inflation. And notice also we're assuming that our expectation of inflation is constant at 4%. Another big assumption, because inflation can also change. Compounding it for 3 years, we take that amount, $15,748, take 80% of that, and then we have the $12,598. Now take a look at these numbers. This whole chart was to calculate those 3 numbers. Also recognize that we could have done this for 300 years, just very systematically doing this. Also recognize it is systematic, so we could something easily that could be put into an Excel spreadsheet. Look at these three numbers. I'm going to transpose them here in blue. So we basically have this additional chart to calculate these nominal after-tax net returns. It's also important to recognize this, that if you do this sequentially, this is not hard. But if you try and solve those numbers without sequentially going through those steps that we've just belabored here, it's going to be hard. But if you follow the steps outlined here in this book, it's just simple arithmetic. Okay, what's our next component? Our tax savings from depreciation. The allowable depreciation in this case, we find the cost basis divided by depreciable life. And I've had students come in on their homework and couldn't get the right answer because they were taking the cost basis minus the salvage value. No, this is for tax purposes. Uncle Sam allows you to depreciate that out to 0 over the depreciable life of that investment. The depreciable life is what is determined by your congressman in tax code, in tax law. So this isn't the depreciation that you've learned to calculate in your farm management classes. This is for tax purposes. So the cost basis was $80,000. In the problem set again, it says that you can depreciate the irrigation system over 15 years. So this farmer then can claim or deduct $5,333 from his taxable income every year. And if you deduct that from your taxable income, there's a tax savings. And that tax savings we'll talk about in a minute. First of all, I have this question that I want to address. This is to test if you understand what we talked about. It also helps to bring home the fact why it's important to understand those definitions that we addressed, even though you probably didn't see any relevant. Is this depreciation that you get to claim every year, is it nominal or real? Does it change? If inflation rages is 100%, does this number change? It doesn't change, does it? So does that make it real or nominal? That's why this makes this a good question, because it's very easy to say it's constant, so you might argue it's real, but is it? What is nominal? It's the countable dollars. No matter what happens to inflation, what do you get to claim? $8,500. That's how much you're going to deduct. That's the actual amount, so it's nominal. Even though it's constant, in an inflationary environment, if you've got a constant income, what's happening to its real purchasing power? It's going down. So the idea of constant isn't right, because that just means that in an inflationary environment, its real value is going down. The nominal is constant. It's countable. That's what you actually observe. That's the amount that you deduct your taxable income. So the tax savings from depreciation is the depreciation times the tax rate, because you deduct your taxable income by $5,333. That means you don't have to pay 20% of that, which means you save $1,067. And that $1,067 is nominal. And no matter what happens to inflation, that's the dollars that you save in your taxes. Under that scenario, what happens to the real value of that tax savings? It's going down. And in fact, we'll talk more about that as we go through this class. That's why there's a lot of talk about having the taxes be adjusted for inflation.